Cynthia, thanks very much for your kind words. I want to thank Integrated-Equities and their entire team for putting on this presentation. We really appreciate yourselves giving sponsors like Revesco an opportunity to discuss our platform. My name again is Scott Lee. I'm one of the founders of Revesco. I'm going to talk about investing in U.S. commercial real estate and specifically about Revesco Properties Trust. So just highlight kind of what we're going to run through, just to who we are and how and what we do for Revesco, a little bit about the fund and the results, and really kind of why open air retail. So let's dive in. So Revesco is essentially a Vancouver-based story. It is essentially myself, Chris, and Reese, who've known each other since actually university, and we've been friends ever since. We've been in the commercial real estate world, as Cynthia said, for over 30 years. And our backgrounds are all directly related to what we do at Revesco Properties Trust. Chris and I, we formed Northwest Atlantic in 1996, which was a commercial real estate brokerage firm that just specialized just on retail. We ended up representing over about 100 retailers from the US and Europe, and we represented them right across Canada. We had 3 offices, 55 people from coast to coast. And we were able to grow that firm. And then ultimately, we sold that firm to Jones Lang LaSalle in 2018. My partner, Reese, he also started in Vancouver, ended up moving down to Denver in the early 90s, and has been developing commercial shopping centers and developing residential developments, primarily in the Denver metro area. So interestingly, after about the 2008, during the great financial crisis, we saw a huge opportunity in the U.S. Commercial real estate market. And tell me if any of this sounds familiar. We saw a massive, if you recall, you saw a massive interest rate spike. You saw that banks were overexposed to, at that point in time, was residential real estate. And great institutions were forced to sell fantastic assets to deal with fund redemptions and other issues that they had on their balance sheet. So I don't know if anybody sounds familiar to anybody, but it certainly sounds familiar to us. And we recognized that back in 2008. And so at that time, Chris and I were deeply immersed in Northwest Atlantic and running our own business. So we partnered with Reese in Denver, and he was the one that created the Revesco properties in Denver. And we've been investing alongside with him and growing that platform since 2012. And then more recently, Mark Miles joined us as a partner from a local firm here in Vancouver, Dean's Knight Capital. He ran that company for many years, and he joined us as our CFO. So what you see there is a whole bunch of years of experience and a lot of gray hairs, but it served us well and allows us to kind of continue to grow. So just a little bit about Revesco. There's kind of 3 legs to the stool, as we call it. We have Revesco Properties, which is Denver-centric, primarily focuses on purpose-built multifamily rental. We also have a very, very large project in the just outside the downtown Denver area called the River Mile. It's 62 acres of redevelopment lands. It looks like, feels like, if anybody remembers the old Expo 86 lands in Vancouver, right along the river, got a major highway, transit stop, and we got it rezoned for 15 million square feet of additional density, which we'll work with a local partner to build out over the next 15 to 20 years. And then finally, we have Revesco Properties Trust, which really at the end of the day is an opportunity for retail investors to invest in institutional type investment approach on retail shopping centers. So what do we buy? Well, this is a great example. It's called Aspen Place. It's in Flagstaff, Arizona. It's an open air retail shopping center. You can see Whole Foods on one side and REI on the other. Think of Mountain Equipment Co-op as a Canadian example. And then great fashion and quick service restaurant tenants in the middle. It's the dominant retail location in Flagstaff, Arizona. Universities nearby. It's just a great little market for us, and is kind of a model, if you will, for the types of things that we typically acquire. So think about your grocery anchored or your needs-based shopping center. Those are the things we're trying to acquire. Um, we're focused on centers like, for example, Caulfield Village in West Vancouver. For those of you in Edmonton, the Save-On Foods at Hampton Village in Southwest Edmonton, or for those of you in Toronto, for example, would be the Longos at Leslie and York Mills in Toronto. Here's what we don't buy. We do not buy enclosed malls. Anytime you have to put a roof on something, you've got to heat it, you've got to secure it, you've got to clean it. It becomes very expensive, and it's not what we focus on here at Revesco. What we typically buy are shopping centers that are below replacement cost. Obviously, the cash flow is extremely important to us and our investors. And we look for credit tenants. Those are tenants, for example, like in a Canadian context, would be your major grocery stores or your Winners, Marshalls, HomeSense. Those types of tenants are what we typically try to focus on because A, they pay the rent come hell or high water, they're always paying the rent, and we have extremely deep relationships with them. We can get great intel from them, and we'll talk a little bit more about that as the presentation evolves. So what do we do? How do we, basically our ultimate role here is to provide steady cash flow to the investors, as well as increase the value of the units. And we do this by systematically executing day to day on these 4 key elements. They're not very sexy, not very exciting, but this is what drives value. And if I would pick any one of the 4, it's the restructuring of leases that probably does or can help the value of these shopping centers that we typically acquire. What do I mean by that? Like, for example, Staples, in a market that we had bought a shopping center. Staples is based in Boston. They made a bet thinking that they would not renew their lease. They figured they could perhaps grind out a better, lower lease rate on us when their lease expired. They obviously didn't know the market as well as we did. We were able to not only renew them, but increase their rent by 20%, allowed to extend the lease as well, and created a bunch of value for the shopping center and our investors. And that's kind of what we do through the process along the way. So how do we do that? Well, Chris and I have had a working relationship with most of these retailers over the last 30 years of our career. And it's one of those kind of situations, like, for example, last week, Cynthia, I was on the phone with a fellow named Paul Hilliard. Paul Hilliard now is the Senior VP of Real Estate for Whole Foods and Amazon Fresh. Now, having that type of access to those types of people allows us to really do some great underwriting when we're looking at acquiring a shopping center. We can make these calls, we can find out what the center is doing, we can find out how they're performing at that location, and really, at the end of the day, just helps reduce the risk for our investors and Revesco Properties Trust. So I guess at the end of the day, what does this mean to you as an investor? Well, we try to make sure that we differentiate ourselves by the following. We invest 10% of all the equity. So we invest basically side by side on each acquisition up to $5 million. So our money's right beside yours. Unlike a lot of groups, we have been through a lot of rising interest rate cycles. So we do not use any variable rate debt. And in commercial shopping center world, variable rate debt can kill you. So we do not utilize any of that whatsoever. We have a very systematic debt strategy. No more than 15% of our total debt renews in any 1 year. And as I mentioned before, we have unparalleled access to tenant information. So just a little bit about the fund. It's really, I guess, we've had a number of acquisitions over our career prior to Revesco Properties Trust. We over $400 million in acquisitions. And then when you include the sale through, over $600 million in transactions, you can see the returns over a 12-year period. And it's that track record that gave ourselves the confidence to share our investment approach and our returns with other investors like yourselves. So here's the quick review of the portfolio where it stands today in the last 2 years. A couple of key metrics that I would draw your attention to. One is the 99% occupancy level. That's one of my core focuses is making sure these shopping centers are full. We utilize our relationships and our skill sets to keep them a maximum occupancy at all times. We have a very low average mortgage lease rate, as you can see there. And we also have what we call a very healthy weighted average lease term. And so what this means essentially is it's a calculation of the average remaining lease term for all the tenants in the portfolio, taking account how much rent they're paying as a percentage. You don't want, for example, a really high number because that means you've got no growth and no room to increase your net operating income. But you don't want a low number like a 1 either. That means you've got most of your portfolio, turning over in 1 year. So we try to find a balance there, and I think we've done that over the last couple of years. Just a little bit about our investment highlights. You can see we aim for about a 12 to 15% annual return. You can see our preferred distribution rates there, as well as, again, we co-invest with our investors. And I think that's really important in any sponsor. So, our results, because our investment approach is similar to what most institutional sponsors in our world would perform, we think we've done a very good job, especially, it's early days for the fund, as well as the fact we just come through a very tumultuous period in the interest rate world of the last couple of years. So I think you can see here through our performance, we're heading in the right direction. We continue to kind of move forward. That gives us more confidence in our investment thesis and our abilities to deliver returns, not only in the short term, but also really this is built for the long term. This is a long-term wealth, product, if you will. Here. So let's talk a little bit about kind of the why retail, if you will. I guess probably the number one reason why retail for Revesco is that it's a market we know really, really well. We know the ins, the outs. We've been around long enough. Quite honestly, we've probably created some of the lease clauses that drive a lot of other people crazy, and we know how to unwind those. So we're very confident in this world. And most institutions don't love it because of its complications, but we thrive on it. Statistically, over 85% of sales are still done inside stores. So what we've come to realize that most successful retailers have to have a foot in the physical presence of bricks and mortar and have a very strong e-commerce platform. I always use the example of Lululemon. I go to Lululemon near my office at Robson and Burrard, go inside, try to pick up a pair of pants. For some reason, they don't have my size. The sales associate gets on her phone. She orders it for me online and has it delivered to my house. So the next day, I get the pants. For some reason, they're the wrong size. I go back to the store, make an exchange, or buy some other goods. The common factor here is still the store. It's still the genesis of all good retail. And e-commerce just helps add on to that success of that retailer. The other factor here to consider is in our 30-year career in retail, the vacancy rates have never been lower. They typically hover around 8, 9, 10%. And they've been trending down, and they're now as low as 4.5%. And if you dig in further on the 4.5%, and just look around in some of your own cities, for example, the downtown cores may have predominantly most of that vacancy, but the suburbs are just extremely strong, and there's very little vacancy rate whatsoever. I was having breakfast this morning with a tenant that runs a company called Pet Value, and they're in the United States. And he is getting quoted lease rates that are just unbelievable, unthinkable when compared to 2, 3, 4 years ago. That's how fast things have risen because there's just such little supply in the marketplace. And there's a couple of reasons for that. Retail has been out of favor for so long. If you look at where the equity flows have gone in the last, call it 10, 15 years, most developers would either rather build industrial, up until recently, you'd say office, but that's gone, and residential. As a consequence, the supply of retail has dwindled while population growth continues to kind of grow. And so therefore, you see this dynamic that we have today. And then, lastly, keep in mind, in the US, there's been on average, there's been over 100 enclosed malls per year that are demolished. So those tenants have to go somewhere. And that's continuing to happen in the marketplaces that we look at in the US. So, finding why Revesco? Well, we've been doing this a long, long time. And so we're very comfortable and very experienced in this field. Our money is right beside yours. And we believe with our institutional approach, if you will, we can share those opportunities with our investor partners alongside yourselves. And that's it.